Tom is 78, Linda is 68, 10-year age gap. The front porch of their paid-off Asheville mountain house has 2 coffee mugs on the rail, one still warm, one already cold. The driveway is empty because Tom drove the Subaru up to the cardiology appointment alone this morning. $1.5 million sits in Tom's traditional IRA, built over 35 years near the top of his industry's wage base. $500,000 sits in Linda's Roth IRA from her own working years. Social Security pays them both, the kind of retirement most American couples never reach. Here's what nobody tells them. Tom dies January 2026. Tax year 2026 is still joint. That's the year of death rule under Internal Revenue Code Section 6013, Subsection A, Paragraph 2, and Subsection C, fleshed out by Treasury Regulation 1.6013-1. But starting 2027, the Internal Revenue Service sends Linda a bill she didn't sign up for, about $9,000 a year, every year, for the next 19 years. Roughly $172,000 in extra federal tax, purely because her filing status changed. This isn't an estate tax story. It isn't a probate story. It's a math problem hidden inside the United States tax code, and it bites every widow whose late husband was a high earner. 3 statutes matter. 3 years matter. 1 window matters. Let's walk it. Let me show you the named couple. Tom's 2018 Social Security Administration award letter sits in a kitchen drawer folder in Asheville marked with a paper clip next to Linda's draft 2026 widow tax return. Tom was born 1948. His full retirement age is 66. He spent his career near the top of the Social Security wage base primary insurance amount, near the 2014 actuarial cap of $2,642 a month. He claimed Social Security in 2018 at age 70, 4 years past full retirement age, locking in the maximum 32% delayed retirement credit. The Social Security delayed retirement credit accrues at 8% per year past full retirement age up to age 70, set by statute. At claim benefit in 2018, about $3,300 a month. 8 years of cost of living adjustments later, including the 2.8% 2026 adjustment, the Social Security Administration announced on October 24, 2025, his 2026 benefit lands at $52,272 a year, just under the actuarial ceiling for his cohort. Linda was born 1958. Her full retirement age is 66 and 8 months under the cohort table at 42 U.S.C. Section 416 sub L. She has her own modest Social Security record from years of part-time work after raising their 2 children, but Tom's record dwarfs hers. When he dies, she'll claim survivor on his record, and her smaller own benefit folds into the survivor amount. That's how the Social Security Administration computes a survivor benefit when both spouses have records. The year of death rule deserves its own beat because most retirement videos misstate it. Internal Revenue Code, Section 6013, Subsection A, Paragraph 2, and Subsection C, together with Treasury Regulation 1.6013-1, say this: a surviving spouse files married filing jointly for the full calendar year in which the spouse died. Subsection A, Paragraph 3 of the same section governs who actually signs that return after the death, the surviving spouse or the executor, but it does not control whether the year is joint. The year is joint treatment flows from Paragraph 2 and Subsection C, not the part of the year before the death, the full calendar year. Tom dies January 2026. Linda files joint for all of 2026. That's why the widow penalty starts in tax year 2027, not 2026. And that's a one-shot double-wide bracket window most retirement playbooks forget exists. Tom dies in January 2026. Linda is 68, past her full retirement age, so she steps straight into the full survivor benefit. No rib limb reduction, $52,272 a year for the rest of her life. Now the bomb. Picture a 2026 federal tax return as two side-by-side columns on Linda's kitchen table. Married filing jointly counterfactual on the left, single filer on the right. Watch what happens to taxable income when the filing status flips. One scoping note before the math. To isolate the filing status effect, we hold household income constant. Same $80,000 IRA pull, same $52,000 Social Security check. Linda's smaller own and spousal benefits get absorbed by the survivor benefit when Tom dies and stay constant in the counterfactual either way, so they fall outside this comparison. The widow penalty we're quantifying is purely what the Internal Revenue Service adds on top of the income loss. Tax year 2026. Tom dies in January, but year of death is still married, filing jointly for the full calendar year under Internal Revenue Code Section 6013. Linda files joint one last time. Standard deduction for 2026 per revenue procedure, $2,025 $32,200 plus $3,300 for both spouses being 65 plus. That's the Internal Revenue Service senior add-on at $1,650 per spouse plus $12,000 from the One Big Beautiful Bill Act senior bonus under Section 70,103. Total deduction, $47,500. She pulls $80,000 from his IRA, takes their Social Security, sits comfortably inside the 12% bracket. The joint 12% bracket runs from $24,800 to $100,800 in 2026. Federal tax for 2026, about $8,700. That's her last joint return. Tax year 2027. Now Linda files single. Same $80,000 IRA withdrawal, same $52,000 survivor check. But now her standard deduction is $16,100 plus the $2,050 single senior add-on plus a One Big Beautiful Bill Act bonus, phased down to roughly $3,000. Here's the phase-out mechanic. The bonus is $6,000 per filer, but it phases out at 6 cents on the dollar above the modified adjusted gross income floor, $75,000 for single filers, $150,000 for joint. The single floor is exactly half the joint floor. Linda's single filer modified adjusted gross income lands well above the $75,000 single floor, and the 6 cents per dollar phase-out cuts her bonus roughly in half. Total deduction, $21,184, less than half what she had jointly. Federal tax for 2027 jumps to $17,426. That's an $8,691 penalty in her first single year. Same income, same person. The check writer just changed her filing box. Now layer in IRMAA, the Medicare Income Surcharge, a staircase of premium tiers calculated on income from 2 years earlier. For 2026, per the Centers for Medicare and Medicaid Services release of November 14, 2025, the single IRMAA staircase has 5 tiers above the base. Tier 1 starts at $109,000 of modified adjusted gross income, $1,148 a year in extra Part B and Part D premiums. Tier 2 at $137,000, $2,885. Tier 3 at $171,000, $4,621. Tier 4 at $205,000, $6,356. Tier 5 at $500,000, $6,936. The single thresholds for Tiers 1 through 4 sit at exactly half the joint thresholds, dollar for dollar. Tier 5 is the exception. Congress added the top tier in the Bipartisan Budget Act of 2018 and locked the dollar amounts by statute. So the single floor stays at $500,000 while the joint floor sits at $750,000, 2/3, not 1/2. The freeze runs through 2027, with inflation indexing scheduled to resume in 2028 under 42 U.S.C. Section 1395R. The 2027 IRMAA is calculated on 2025 income joint, Tom alive. Linda escapes the surcharge. The 2028 calculation uses 2026 income, the joint year of death return, still under the joint IRMAA threshold of $218,000. Escape continues. By 2029, the look back finally surfaces 2027, Linda's first single filer year. Modified adjusted gross income crosses $109,000, the single IRMAA Tier 1 floor for 2026, and she picks up that $1,148 a year in Part B and Part D surcharges. That's where the second leg of the bomb begins to bite. And if her modified adjusted gross income crosses any single filer threshold during these transition years, she files Social Security Form 44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. Spouse death is one of the 8 qualifying life-changing events the Social Security Administration recognizes under its Program Operations Manual Section HY 21120.005. The form takes 30 minutes. She downloads it from the Social Security Administration website, fills it out by hand, attaches a copy of Tom's death certificate and an estimate of her current year income, and mails or hand delivers it to the local field office. The Social Security Administration resets her IRMAA tier on appeal back to where it would have been under the lower current year income. Most widows never file this form because nobody tells them it exists. Stack the calendar across 19 tax years from 2026 to 2045. 3 regimes. Phase 0, 2026, the joint year of death return, no penalty. Phase 1, 2027 and 2028, single filer with the One Big Beautiful Bill Act bonus still active, and IRMAA not yet biting, $86,891 each year. Phase 3, 2029 through 2045, the One Big Beautiful Bill Act bonus sunsets by statute on December 31st, 2028, and IRMAA surfaces. $9,078 a year times 17 years equals $154,326. Phase 2 collapses into Phase 3 because the sunset year and the IRMAA onset year are the same year. Let's add the lifetime bomb. 2026, no penalty. 2027 plus 2028, $17,382. 2029 through 2045, $154,326. Total, $171,708 in today's dollars across 19 tax years of single filing, holding the current bracket structure and the One Big Beautiful Bill Act sunset constant. The bomb scales roughly linearly with the age gap. A wider gap means more single filer years before Linda dies. A narrower gap means fewer. The mechanism is identical, only the runway changes. Now the standard recommendation sees the bomb and suggests Roth first. Pull from Linda's $500,000 Roth IRA instead of Tom's traditional IRA. One detail most retirement videos skip: when Tom dies, his $1.5 million traditional IRA passes to Linda as a spousal beneficiary under Internal Revenue Code Section 408, subsection D, paragraph 3. She elects to treat it as her own. No 10-year Secure Act forced distribution that hits non-spousal beneficiaries. Her required minimum distribution clock starts on her own RMD, age of 73, under Secure 2.0. So both accounts are hers, and she can choose which to drain first. A 6.25-year green stretch on the withdrawal calendar, followed by 13 3/4 years of red. $80,000 a year out of the Roth runs the account dry in 6.25 years. During those 6.25 years, 2027 through early 2033, the bomb is neutralized. About $56,000 of bomb diffused, but the Roth runs out. For the remaining 12 3/4 years, she's back on the traditional IRA, and the bomb resumes. About $116,000 of bomb still hits her. So the honest framing, the one most retirement videos won't give you, is this. Roth first neutralizes about a third of the bomb during the first 6 years of single filing. Then the Roth depletes, and the widow penalty resumes for the back half of her life. It's not a save, it's a delay. The actual fix has to start before Tom dies. Picture a Social Security Form 44 on Linda's Asheville kitchen table next to a Roth conversion calendar dated before Tom's death. 3 moves. 1. Roth conversions during the last joint filing years every year Tom is still alive, plus the joint year of death itself. The full 2026 calendar year is joint by statute, even if Tom dies in January. That's a one-shot double-wide bracket window. The joint 12% bracket runs from $24,800 to $100,800 in the 2026 per Revenue Procedure 2025-32. The joint 22% bracket goes up to $211,400. Convert into the joint 12 and 22% brackets aggressively. Pay 12 to 22 cents on the dollar now, and Linda inherits a larger Roth balance that does not generate single-filer ordinary income later. Every dollar moved is a dollar that won't get taxed at single-filer rates later. 2. File Social Security Form 44 the moment widowhood triggers, and rerun her tax projection every fall during the open enrollment window. The widow penalty compounds, but it also responds to active planning. The form is free, the field office reset is procedural, and the IRMAA savings in the first single filer year can pay for a year of cardiologist copays. 3. Time the Roth depletion strategically, front-loading Roth withdrawals into 2029 onwards when the One Big Beautiful Bill Act has sunset and the per-year delta is highest, diffuses more bomb per dollar than spending Roth in 2027 when the per-year delta is still small. The point is sequencing. Spend the Roth in the years when the alternative traditional IRA income would cost the most. 3 numbers to take with you. $171,708 lifetime bomb across 19 tax years of single filing, 2027 through 2045. 2026 is the joint year of death return, no penalty that year. $9,037 average annual penalty across the single years. About a third neutralized by Roth first, not the whole bomb. The rest is what conversion while married is for. The North Carolina state tax side is small, flat 4.25%, Social Security exempt, with a roughly $300 a year widow side standard deduction delta. Footnote scope. State tax outcomes differ sharply in California, New York, and Minnesota, states with steeper progressive brackets and partial Social Security taxation. The federal layer is the same everywhere. The state layer is its own conversation for a different episode. If Tom's still alive and you're inside a 10-year age gap, this is your window. Don't wait. This week, sit down with Tom's most recent Social Security statement and your last joint tax return. Pencil out one Roth conversion, even a small one, into the 12% bracket. The conversion paperwork takes 10 minutes. The window is 1 calendar year wide on the day Tom dies, and then it's gone forever.